Welcome back to the Noob Selling Options channel. Today's explainer is a total deep dive into something every single trader dreads, but you absolutely need to understand it. We're going to break down exactly why markets suddenly, and I mean violently, collapse when leverage just runs way too hot.
Seriously, have you ever stared at your screens and just wondered, why do perfectly healthy markets suddenly crash 10% in a single day? Okay, let's dive into this mystery. Because we see it all the time, right? Assets with bulletproof fundamentals, like, say, AI chips that are literally sold out for years, just taking a massive plunge in a matter of hours. It honestly makes zero sense if you're only looking at traditional valuations and company earnings.
But to really grasp this, we got to look at the golden rule for our thesis today. Quote, when a market is oversaturated with debt, prices stop tracking intrinsic value and begin tracking pure structural liquidity, unquote. You kind of have to think of an over-leveraged long market as, well, like an unstable thermodynamic system. It reaches this critical mass where the market doesn't reset because the fundamental story changed. Actually, scratch that. It resets simply because the mechanics literally run out of immediate dollars to sustain all that leverage.
So here's our agenda for today. 1. The anatomy of a market reset. 2. The KOSPI retail margin flush. 3. MU and SNDK's gamma traps. And finally, 4. Spotting the top.
All right, part 1, anatomy of a market reset, diagnosing the disease. First up, we need to understand the exact cold, hard math that fuels these massive, unstoppable liquidations. Now, the fuel for a crash almost always starts over in the derivatives market with the funding rate mechanism. Basically, this is the premium that long traders are repeatedly paying to short traders just to keep their leveraged perpetual positions open. When long leverage gets out of hand, these funding rates absolutely skyrocket. So longs are essentially bleeding cash, right? It creates this super high stress environment where they desperately need the price to go up immediately just to keep their heads above water.
And then, bam, a trigger hits. Maybe it's a tiny macro shift or just an exhaustion of new buyers. The downward engine turns on in 3 brutal phases. Phase A, margin calls hit, dumping forced supply right into the order book. Phase B, the long unwinding and delta shorting kicks in. This is where market makers are mathematically forced to dump their hedges. And then Phase C, the order book void. Liquidity providers just step back to avoid catching the fallen knife, and suddenly, a flash crash materializes out of nowhere.
Let's move on to Section 2, KOSPI, the retail margin flush during the June 2026 crash. Okay, let's look at a real-world symptom of this. Heading into that June, retail margin debt in South Korea had spiked to an absolutely massive record of 37.7 trillion won. Let that sink in. Individual investors were heavily borrowing broker capital, and so much of this debt was pouring directly into newly approved 2x and 3x leveraged tech ETFs. We're talking funds tracking giants like Samsung and SK Hynix. The whole market was basically a powder keg of synthetic leverage just waiting for a spark. Now, what's wild here is that the fundamentals of these underlying companies were absolutely perfect. SK Hynix was running record 72% operating margins, plus their 2026 high-bandwidth memory supply was completely sold out. The trigger for the crash wasn't some huge fundamental failure. It was literally just minor foreign profit taking over in New York and a little bit of domestic disappointment about an MSCI index inclusion. But because the market was so saturated with long leverage, that tiny little dip in the spot price, yeah, that was all it took to light the fuse. The domino effect that followed was totally programmatic and honestly terrifyingly fast. Phase A. As the underlying stocks dipped, those 3x leveraged ETFs were mathematically forced to sell millions of spot shares directly into the falling market just to maintain their leverage ratios. Phase B. That institutional selling pushed prices down to retail margin liquidation thresholds, so automated broker risk engines just started auto-liquidating accounts left and right. And then Phase C, by 2:33 p.m., the bid-ask spreads completely hollowed out, and a level 1 circuit breaker literally froze all trading on the exchange, just shut the whole thing down. And that mechanical, forced cascade, it resulted in a brutal 9.99% wipeout for the entire KOSPI index in a single day. But hey, let's be super clear, this is definitely not just a retail phenomenon. Let's juxtapose the raw retail margin debt of that KOSPI crash against the highly sophisticated institutional wipeout we saw in US tech around the exact same time. Bringing us to Section 3, MU and SNDK, gamma traps and the institutional wipeout. Let's break down the devastating mechanics of this trap. The crucial part is understanding how this specific loop is built. So institutions aggressively bought out-of-the-money call options on these memory stocks. Now, to stay market neutral, the institutional market makers who actually sold those calls were forced to go out and buy millions of shares of the underlying spot stock as a hedge. So they basically acted like a giant vacuum, artificially pumping the spot price straight up into a leverage-fueled bubble. But what was the trigger here? Just a simple momentum stall. When the broader tech market cooled off, time decay, theta, became an existential threat to these over-leveraged longs. In the options market, if the price just goes sideways, those out-of-the-money calls rapidly decay towards zero. The moment the upward momentum broke, it acted as this incredibly subtle trigger for the trapdoor to just swing wide open. As prices ticked down, the whole mechanism violently reversed. Phase A. Market makers de-hedged. They suddenly dumped millions of spot shares back into the order book because, well, they didn't need to back those dying calls anymore. Phase B. All this forced selling pushed prices even lower, causing short-dated put options to suddenly flip deep into the money. And guess what? That forced market makers to short even more stock to hedge their exploding put risk. Finally, Phase C. A complete and total liquidity void. Because these memory stocks are highly correlated and the order book's completely hollowed out, SanDisk cratered 13.6% and Micron plunged 13% in a single trading session. Again, this had absolutely nothing to do with a drop in demand for AI chips. It was a pure mathematical derivative market reset. All right, Section 4, spotting the leverage top and its warning signs. So how do you, as a dedicated noob selling options viewer, spot this structural fragility before the collapse actually happens? Well, here are the warning signs you really need to look for. You want to compare healthy metrics against the danger zone. Watch out for open interest hitting all-time highs while the spot price is just moving sideways. That's a huge red flag that indicates heavy borrowing just to sustain the current price. You're also looking for extremely high, spiking funding rates, retail margin debt surging entirely out of proportion with the total market cap, and a severely skewed long-to-short ratio, where the market is basically entirely long and completely missing those crucial short counterbalances. But, here is the silver lining to all of this. Despite the absolute pain they cause to over-leveraged traders, these resets are fundamentally healthy. They're necessary. They flush out the weak hands and the speculative leverage. They reset the cost of capital back to a baseline, which allows funding rates to finally drop. And most importantly for disciplined capital, they create incredible high-conviction entries. We're talking about opportunities where premium assets get pushed well below their intrinsic value purely due to forced algorithmic selling. The market is always going to choose the path of maximum pain to efficiently clear out unhedged leverage before it makes its next true leg up. So my final question to you is this. Will you be the one trapped by structural liquidity or the one ready to buy the reset? Let us know what your strategy is in the comments down below. And hey, be sure to hit that like button and subscribe to the Noob Selling Options channel for more deep dive explainers just like this one. Keep your leverage in check, and we'll see you in the next one.